Okay, so welcome. Basically, the methods explained in this webinar are going to be a little bit complex. So if you're new, if you just started trading, this might be a little bit confusing for you. So I would say you need to go back to the basics, learn the basics, and then watch this webinar. We're going to be going over some things which might not look apparent to you in the moment, but once you start practicing, once you start seeing them over and over again, it will all start to make sense. So we got 4 more minutes. So we're going to take a little break here. We're going to start in like 4 minutes, just waiting for a couple more people to join in. All right, let's continue on here. So basically, this webinar is titled, as you can see, "Giving Your Trade a Second Chance." The reason of this webinar is because, like a lot of times, what happens is that when we see a clean move, when we see a clear move, what happens is that we'll take a trade, we'll get stopped out, and after a while, price will still go in our way, right? So that's very frustrating. And I've been back testing. Well, not been back. I've been live testing this. I've been testing how to take, the second entries, or how to give your trade a second chance. So now, you have to be very careful when you're giving your trade a second chance. You have to be mindful of the fact that you need to keep risk managed, because if you don't keep risk managed, and if you're using your full risk on the first attempt, and the second attempt is going to be added risk, then it's not going to work. It's going to be very, very risky. So this webinar is for you if you see a perfect trade but get stopped out all the time, don't know where to enter, where to put stop losses. I know we've been through this second point a lot of times, so I think it's going to be a good refresher to go over this again. Trade runs in your favor after getting stopped out. So we're going to see how we can enter second positions, trading based on fear rather than logic. What this basically means is that when you take a trade, and it's a logical trade, it makes sense, you take a trade, it stops you out, and then when the new opportunity comes, you're not confident enough to take that trade. Why? Because now you're trading based on fear. Now you're trading based on the fact that, okay, you got stopped out the previous time, so now this time you might get stopped out again. But in reality, the new trade is completely independent of the last trade, right? So let's move forward here. Let's see what we got. So first of all, we need to identify what are the best times to trade, You know, most people, what they do is they want to come back, they want to come in the afternoon sessions, or they want to come in around, like, you know, when there's not enough volume. So you need to identify what are the best times to trade. The number one best time to trade is when there's volume in the market, right? So you have to ask yourself, when is there volume in the market? When markets open or when markets close? You know, that's when you have a lot of volume in the market. So if you think about it, the only time we should be trading is when, you know, let's say you're coming to the market when there's pre-New York. When you have pre-New York, you know, there's a lot of volume in the market. So that means you could catch some moves. That means the candles are going to be big enough for you to catch a trade. You know, so let's say pre-New York, New York open, and then you have London close. Actually, let's go to the next slide right over here. Okay, perfect. So when we're over here, these are the premium times to trade. Let me get the red one here. So you can screenshot this, take a picture, whatever you want to do. These are the key times to trade. So let's say you're waking up at pre-London, right? Pre-London, you know, there's going to be some sort of volume between 1:30 and 3 a.m. Eastern Standard Time. This is the key time to trade when there's going to be volume in the market. You know, what most people do is, now when you come to the markets, you're told three things, right? The first thing you're told is that, hey, you know what, man, this market, it's opened 24 hours a day, 5 days a week. So you can trade at any time you want, you know. Second thing you're told is it's a $5.2 trillion market. So that means you can get as much money from it possible. The third thing is that the market is there to serve you. That's wrong. You are there to serve the market, right? So you need to identify what times are going to suit you best, right? Let's say you have a job, right? You have a job and you come home and the only time you have left to trade is this time. Or maybe, like, you know, you come home at like 5 p.m. or 6 p.m. So you only have this time to trade. Asian and Asian. So when you're coming to the charts that, let's say, after Asian Open, or let's say at around 11 p.m. Eastern, when there's no volume, what you're going to notice is you're going to notice that the candles are going to be smaller. There's not going to be enough volume in the candles. Like, the candles aren't going to print what they're supposed to print, you know, because sometimes what happens is that guys will say, okay, you know what, I'm trying to trade wick fills and I'm looking at the market at 3 p.m. Eastern. This is afternoon New York time. When all markets are closing, there's no volume, and price prints something that you like, and you try to take a trade, but it doesn't work out. The reason why it doesn't work out is because there's not enough volume in the market. You need volume in the market to move price, right? This is why it's very important. Before we even talk about taking positions, you have to identify what time is going to suit you best to trade, right? Some people, like, you know, there are a lot of guys in my Slack group, they trade pre-London till London Open, because they have identified that, okay, these are the times when there's volume in the market. You know, me personally, I trade between these times, between 6:30 a.m. Eastern to like 9:30 a.m. Eastern, because I know during this time, there's a lot of volume in the market. And this is the only time I'm trying to trade. You know, what most people do is they'll say, oh, you know what, I'm going to trade the London session, and then I'm going to trade the New York session, and then I'm going to trade the Asian session. That makes no sense. And the reason why it makes no sense is because when people come to trading, you come to trading to have independence of time, you know. And when you're focusing on all these different sessions, man, you don't have independence of time. Then you just slave to the markets, because that's what I used to do. I used to come to the charts in the morning, so I would trade the New York, and then I would try to trade the Asian. Asian would be 50-50 because there's less volume there. Then I would wake up at night to trade the London session. That would always be lost. So this was a very, very toxic environment I was in terms of trading. You know, so I had to make a change. You need to make a change. You need to choose one session. Contrary to popular belief, the more sessions you look at, or the more time you spend on the charts, the better you're going to get. No, that's false. I hear guys say you need to put hours in the charts. You need to put time in the chart. You need to grind on the charts. All that is good. You need to grind on the charts, but you need to be logical about that. You know, it's not like you're going to be on the charts all the time, or you're going to be on the charts while you're at the dentist or at the grocery store. That doesn't work, because you need your own personal time too. So when you're looking to take entries, you're looking to see what time of the day is going to suit you best to trade. That's very, very important, because the longer you could spend that amount of time on the charts, so like let's say if I lived in Europe, right? So I lived in Europe, and the best time for me to trade would be this time here. Early mornings in Europe, which is going to be London Open and Euro Open. So this is going to be the best time for me to trade, because I know that, okay, if I can spend enough time watching this session, I can eventually get good at it, you know. Then I can eventually look around and say like, hey, like, you know what? I know this session really, really well. Just like now, I've spent a lot of time looking at the pre-New York and New York session. So I can turn around and say, okay, you know what? I know a lot about this session. I know exactly what's happening in this session, right? But when you try to mix two sessions together, man, then you start to get confused. Because if you're looking at a pair like, let's say you're looking at a pair like GBP, JPY, right? You're looking at GP JPY. So what's going to happen with GP JPY is GP JPY is going to move differently in New York than it would move in Asian. The reason why is because in the Asian session, the pound is closed, right? Pound's not open, but the yen is open. So GP JPY is being run by the yen. You know, when you're looking at pre-New York or New York, GP JPY is being run by the pound, you know, which is open in New York and pre-New York. And the same thing goes for the London, right? So when you're focusing on one pair, you need to realize that, hey, this pair is going to move differently in all three sessions. So that's why it's really important. Now, I know a lot of guys here, they have like, you know, you guys have jobs and stuff like that. So you need to understand what time of the day is going to suit you best to trade. And you just have to do that. Trust me. Once you start to do that for a number of days, I'd say like a couple of months, you'll start to see patterns. You'll start to see like, you know, different relatable moves that happen over and over again during that session. And once you start to see those moves, eventually, naturally, you're going to start to add on more risk to those trades. That's going to happen with time. You know, it's not going to happen with like looking at all the sessions and looking at 3-4 pairs. No, that's fool's gold. That does not exist. I tried that. I know a lot of people who tried that and they still try it and it's not working. You know, so you have to choose one session before even talking about, okay, how many trades you're going to take, right? Which is why I thought that this slide was really important for people to understand that what time of the day there's a lot of volume in the market. And based on that volume, then you can start to take some profitable trades, which you can say, okay, like, you know what, there's enough volume in the market, I can probably take more trades. Right, so let's go to the next slide here. So this is really important, right? It's really important. The times of the market, when there's volume in the market, this is extremely important. Let's move to the next part here. Okay, so what happens to price? What mostly happens to price and momentum, right? When we talk about there's a lot of volume in the charts, when we talk about that there's a lot of like, you know, the prices and momentum, there's a lot of volume, there's a lot of volatility. What's happening when there's a lot of volume in the charts? You know, two things happen. Now, the first thing happen is that the price will eventually create a high, or the second thing that's going to happen is that price will eventually create a low. That's it, right? Price will make a high or price will make a low when there's a lot of volume in the market, depending on where the trend is. If the trend is bearish, price will make a low. If a trend is bullish, price will make a high. Really simple, right? The third thing that the price will not do is consolidate. You know, price will only consolidate when there's going to be less volume in the market. You know, when you're looking at the charts around, let's say 2 p.m. Eastern Standard Time, there's going to be, most likely there's going to be consolidation in the market. Or if you're looking at the market at around 10:30 p.m. Eastern or like 12, like midnight, there's going to be consolidation in the market because there's no volume in the market. Makes sense? So when I see guys trading, let's say the at midnight, or I see guys trading at 3 or 4 p.m. Eastern, I just turn around and say like, why? There's no volume in the market. When there's no volume in the market, why are you even looking at trades? Why are you even looking at charts? What sense does that make? That's like you went to your job, you did your work, you came out of your job, you sat in your car, and then you proceeded to look at the building. Why? There's nothing to do. You're just going to go home. Just go home. You know, charts are just like that. There are times in charts when there's a lot of volume in the market. It gives you opportunities to trade. And then there's a time in the chart when there's no volume in the market. You know, when there's no volume in the market, price is not making a high, price is not making a low, price is just consolidating. So you have to understand that this concept is very, very simple, but to implement this concept when you have MetaTrader on your phone, you have MetaTrader on your computer, or whatever you use, like having those platforms like accessible to you so easily, that can really derail you off of your plan. So you really have to make sense of that, right? So okay, what happens when price is making a high, right? Let me just get my error. So when price is creating a high, right? I'll tell you what happens. There's always going to be a pullback. There's a pullback whenever price creates a high. Whenever there's a pullback, there's an 80% chance that price will come back up to retest that high. This is proven. I've seen it happen. We have live sessions here on YouTube since August 2019, and most of the trades I've taken are based on when there's a lot of volume in the market. And this is what we call trading the trend. It's very important, trading the trend. A trend is traded when price makes a high, comes back down, creates the support, and then retests the high. Or when price is trending down, it creates a low right over here, it retraces, creates a minor resistance, and then proceeds to come down to retest the low, right? So now when price is going up, let me get a better color here. When price is heading up to retest the high, that is the trade you're taking. That's the move. You're saying, okay, you know what? I'm going to capitalize on this move. Because if price is creating a support in an uptrend, right? That's what they say, right? They say, hey, like, when price is trending up, you buy the dips. Or when price is trending down, you sell the pullbacks, right? So this is the dip. Price went up. Price made a dip, formed support. And then once support is formed, price is going to continue up to retest the high. There's an 80% chance price will continue up to retest the high. Some people are asking questions like what time frames, this and that. I mean, you should just go watch the live streams. So price will go up to retest the high. So that's the move you're taking. It's mostly done on the 30-minute or the 15 minutes. So we're going to talk about that later on here now. So how do we know that price has created support, right? How? Because it's so easy to say, oh yeah, price is going to just make support, then you take high. But how do we know that? So let's draw some candles here. We're gonna do some visualization over here, right? So we're gonna go to our bullish candles here. Let's draw a bullish candle. Let's say you have price heading up, right? It's a candle, price goes up again. You have another candle, price goes up, right? Price makes a high, and then slowly what happens is then you have a candle that looks something like this, right? Looks something like this, starts to come down, it's coming down, right? And then you have like a small body or whatever, right? So basically what had happened here is that price was in a supposedly uptrend, right? Price created a high right over here. Price created high, and now what you're looking at, you're like, okay, you know what? Price has made a high. The trend is up. There's a lot of volume in the market, right? So this is what's going to happen. When you come to the charts, you will see price making a high. You will see there's going to be a lot of volume, and then there's going to be a little pullback, right? There's going to be a pullback, and then there's going to be a little bit of consolidation time, because you have to understand price just cannot keep moving in volume, right? If price is going to move, it's going to pull back. There's going to be some sort of consolidation. Consolidation means that, okay, price is taking a rest. Price is taking a breather right now to continue going up. So now, once we are in an uptrend and a support is formed, how do you identify support, right? How? How is support identified? A support is a level which price cannot break to continue down. That's the support, right? So let's say this is the third. So for simplicity's sake, we're only going to focus on the 30-minute time frame, right? So let's say this is the 30-minute time frame, and the next candle you get after this bearish candle is something like this. You get a bullish candle right over here. So when you get the bullish candle, now you can say, okay, hey, you know what? Maybe price has made a support now, right? Because you had price made a high, you had a bearish candle, and now you have a bullish candle forming right over here. So if a bullish candle is forming right over here, and what we've learned is that price, there's going to be an 80% chance that price will retest the high, where will be our stop loss, right? Where's going to be a stop? So once the support is formed, obviously, like, okay, the stop loss is placed below support. But when price is trending up, what does price make? Price makes a high, and price makes a low, right? Then price makes a higher high, then it makes a higher low, then it makes a higher high, and then it makes a higher low, and it continues on, right? That's what price does. So when you start to look at it from a candle perspective, oh, by the way, this webinar is brought to you by Prime XBT. Prime XBT is a platform we're going to show you guys later on. So, right, so price makes a high like this. So when you have a candle forming, what's going to happen? When the candles are forming, basically what you're going to do is you're going to be like, okay, like, you know what, if prices now continue to go up, that means the candles should respect the lows of the previous candles, and they should continue making high highs and high lows. That's what's not. This is the most simplistic way you can look at when there's volume in the market and when price is making a high or when price is making a low, right? Just wait for a support to be formed. A support is formed after a bullish candle closes right after a bearish candle. And you're like, okay, you know what? A support is formed, so now we can continue to go up. Now, how do we know that this candle here will continue up? That's sometimes, I get that question. Well, Raja, you know what? It seems right. You're right. It's going to go up. But like, how do we know it's going to go up? We don't know, right? We don't know whether the candle is going to go up or not. We're just going based on probability. We're just saying that, okay, there's a high probability that the next candle will now continue to go bullish because the previous candle was bullish at support in an uptrend. That's it, right? And if price is going to go bullish, we're expecting the candle to respect the low of the previous candle in an uptrend, which is going to be this low right over here, right? Because if that low is respected, then price is going to continue to make higher highs and higher lows. So now when you're looking about entries, you're first of all looking to see that, okay, if you're trying to take a buy, you're looking to see that, okay, if I take a buy, where will my stop loss be, right? So wouldn't it make sense to have a stop loss below this candle right over here? Because if this candle is going to respect the low of the previous one, it just makes sense to have a stop loss below the previous candle, like to say that, hey, like, you know what, for price to continue up, it has to respect the low of the previous candle, right? And this is a 30-minute time frame. So basically, the higher the time frame you go into, the stronger this probability becomes. Now, when you're looking at the 15-minute time frame, it might have some sort of it might not be as as better as the 30-minute, because 30-minute confirmations are much, much better. And the 15-minute confirmations are weaker. So proportionally, when you go to the 1-hour time frame, the 1-hour confirmations are much better than the 30-minute. The 4-hour confirmations are much better than the 1 hour, and so on. Right? So this is when price is creating a high. So whenever I come through charts in the morning, I look to see that GJ is going up, or if gold is going down. That's music to my ears, because to me that says, hey, like, you know what, price is making a high. If price is making a high, all I got to do is just wait for price to create support, print a bullish candle, and then I'm going to take my buy. That's all what I'm going to do. So when do you, sometimes you might ask, okay, when do you take this trade? When do you take the buy? That's all on you, right? That's all on you, because before you even start talking about when you're going to take a buy, you need to identify where your stop loss is going to be. So if your stop loss is going to be here, you can take a buy right over here. You can take a buy right over here. You can take a buy right over here. Fuck, man, you can even take a buy right over here, because now your stop loss is down over here. Right? Because sometimes what's going to happen is that you anticipate a price to move, but you hesitate. The moment you hesitate, that's the moment you miss the trade. Your hesitation is making you miss trades, because you know that the moment you're hesitating, that's the right time to enter. And when you miss that trade, you enter late, now your stop is big, you go in a drawdown, and it's just a mess, man. So whenever you're hesitating, just enter, even if that's with a small position. In the same context, if we talk about when price is creating a low, right? What happens when price creates a low? So let's say price is moving down like this, and then we have another candle moving down, and then you have another candle that moves down like this, and then let's have another one more candle moving down like this, And then you're like, okay, perfect. You wake up in the morning and GJ is dropping, and you're like, oh man, okay, GJ is dropping right now. So what should I do? Should I sell right now? But if you sell right now, what might happen is you might see a candle form like this, because now you sold at the bottom. So the candle now starts to move up. You're like, oh man, the market knows me. The market knows me, it reversed. So something like this prints, you're like, okay, perfect. Price made a low. Now it's doing a little retracement. So whenever price is doing a retracement, you're waiting for a minor retracement, a minor resistance to be formed, right? Whenever there's some sort of retracement happening. So whenever this retracement is happening, you're waiting for a candle to maybe form something like this. When a candle forms something like this, you're like, oh man, look at that. Price is now creating a mini resistance. If price is creating resistance, then okay, there's a higher chance for the preceding candles to continue down and to retest this low. And this move down is your trade. This move down is the trade that you're taking. This is the move you're taking. This move down. Sometimes guys say, oh, you know what? Price is making a minor resistance. I know it's going to go down, but I'm going to wait for the support to break. Right? But if you wait for the support to break, man, you're missing on this move, because you have to realize that whenever you have a 1 minute candle move, whenever a 1 minute candle is moving, there are billions of dollars being moved in that 1 minute candle, right? Billions of dollars are moving the 1 minute candle. So when you have a 30-minute candle moving, man, that's a bonus. That's money right there. So my ideology is that whenever if I can anticipate the next 30-minute candle to move in a certain direction, I know that I can scratch that surface. And scratching that surface could be maybe grabbing like a 10-cent lot, or a $1 lot, or a $10 lot, or a $100 lot. It doesn't matter, because candle is just going to move that way. No matter what lot size you use, the market doesn't give a shit. Because it doesn't need your money. That's the whole problem, because sometimes what people do is they think that, hey, whenever they take an entry, the market is watching them and they take out the stop loss. But that's not the case, right? So you really have to understand that a candle movement is your trade. As a retail trader, as a intraday trader, when you're coming to the charts, especially for 2 to 3 hours, man, imagine in those 2 to 3 hours, all you have to do is to anticipate where one 1 hour candle is going to go. That's it. As a scalper, that's my bread and butter. I've made all my money from that. To anticipate where the next 30-minute candle is going to go. And if you're looking at a pair like, let's say, GG or gold, you know that those pairs are very high volume pairs. So 30-minute candle on GG or gold could be about 20 to 25 pips. These days, gold is running at 100 pip 30-minute candles. So you have to really understand those things, right? So in the same way, if the trend is bearish and price is making a low, it will do a retracement, and then it will continue down to retest the low, right? And the same thing applies. So whenever price is trending down, it will make a low, it will make a lower high, and then it will make a lower low, and the lower high, and a lower low, lower high, and a lower low. And the same thing, it repeats in candles too. Look, candle form, even though I drew these candles, but it actually happens too. And the next candle made a lower low and a lower high, lower low and a lower high. And now when you're taking a sell, this is your confirmation candle right here. The first bearish candle is your confirmation candle. So if the first bearish candle is a confirmation candle, now you ask yourself, okay, if I'm going to take a sell, right? If I'm going to take a sell to target the low right over here, what's going to be my stop loss? Your stop is going to be, then you're going to say, okay, you know what? I am anticipating this candle to continue down as long as it respects the high of the previous candle. If this candle retraces higher and breaks the high of the previous candle, then the selling is invalid, which usually happens. Sometimes what's going to happen is that the candle is going to spike up, it's going to take out your stop loss, and then it's going to come back down, retrace, and do some dance, and then it's going to continue to go where you want it to go. And when you see that happen, you're like, oh man, I had the right entry, price stopped me out, and now it's right where I wanted it to be. That happens to a lot of people. And to really monetize on that second move, it takes a lot of balls. It takes a lot of confidence in your bias to take that trade. And we're going to go over this right now. So let's remove this and let's see what the next slide is saying right over here. When are second attempts more probable? That's what you have to ask yourself. That when you get set, let's say that this second candle forms something like this, right? And it stops you out and it starts to continue down. Now you're like, oh man, now what do I do? So let's see here when you can take second attempt. When you're focused on the highs and lows of candles. This is very important. This is extremely important. What I mean by this is, let's say that you have, let's see what's the best way to explain this, right? When you're focusing on highs and lows of the candle. So let's say we had a candle that was going bearish like this, bearish candle, another bearish candle, and then you had candles going bullish like this. You had candles going bullish, and then you had candles going bearish like this, right? Like this. This is the first bearish candle. You look around, you say, okay, you know what? Perfect. This is my opportunity to take a sell. And as you take a sell, the next candle forms, it comes down, and then it wicks all the way up and stops you out, and then it starts to go down, right? So now, when this candle is starting to go down, and when you're focused on the highs and the lows of the candles, what this basically means is you're looking to see what the candle is doing right now, right? You're looking to see what the candle is doing right now. So this is where anticipation comes in handy. So now when you're looking at this candle here, it stopped you out right over here, and now it's starting to head down. So now you're trying to say, okay, you know what? Price went up. It probably made a high, it stopped me out. Now it's starting to come down. So if this candle is starting to come down, and if it breaks the low of the previous candle, then there's a higher chance price will continue to move down. That makes sense? Right? Now, if you get stopped out, and then when this candle is starting to head down, you're like, okay, if this candle breaks the low of the previous candle, there's a higher chance for this candle to continue moving down. Now you're anticipating this trade. Now you're not saying that this candle is going to go down. You're using logic, right? You're using logic saying that, okay, now I'm anticipating this candle to go down as long as it breaks the low of this candle. Now you're putting your trust in this trade. In the opposite side of the spectrum, you could say, oh, okay, what if it breaks the low and then starts to go up? Well, if it breaks the low and starts to go up, then there's no trade. Then you can't take a trade because now your mind is stuck in a idea that, oh, like it might break the low and then go back up. Now you're stuck in fear, right? There's a fine line between trading based on fear and trading based on logic. So you have to really differentiate between the two, because if price is breaking the high and stopping you out, and now it's coming down to break this low, and if this low gets broken for price to continue down, logic dictates that there's a higher percent chance price will continue down to retest the low. But fear dictates that there's a high percent chance that price will break this low and continue to go up and fuck you once again. So you have to really differentiate between the two. So that's why it's really important to look at the highs and lows of the candles. We have a couple of examples here we're going to go over here in a bit. Let's move forward to the next point. When you are anticipating a move, so this is what I was talking about too, that when you are really anticipating a move, so what I mean by this is, now this goes into a broader breakdown of candles. So I'm drinking coffee at the same time. So what I mean by a broader breakdown of candles, now these concepts are, I'd say they're simple because, I don't know, like, to me they're simple, but if you're new to trading, this will be a little complicated concept. So I'm going to try to explain it as simply as possible, right? I'm going to try to do this as simply as possible. I hope people understand it. I know the guys in my group, they probably understand it. Okay, perfect. So let's say you have a candle like this, right? You have a candle like this, and let's say this is the daily candle, right? You have a candle like this, daily candle, price is coming down, whatever, doing yada, yada, yada. And now you're expecting the next daily candle to wake up and then fill this wick down and possibly continue moving down, right? That's what you try to do. So now when you break this down into 4-hour candles, or let's say the 1-hour candles, for simplicity, I'm not going to draw the entire candle. So what's going to happen is that you see candles coming down, right? You'll see candles coming down like this, candles coming down. And then what happens is then you start to see candles start to maybe like, go up here like this. You see candles start to go up. They're going up like this. Now you have 1, 2, 3, 4, 5. And then you have another, let's draw another bullish candle right over here to make it 6 4-hour candles. Perfect. Awesome. So now this is market structure, and this is 2 candles, daily candles, which are filling the wicks, right? So this is the high of the candle, and this is the high of market structure, which coincides with the high of the daily candle. Make sense? Now, if this is the low of the daily candle, then this is the low of the market structure in this first daily candle. You get me, mate? Right? Now, when this wick was formed, when this low was formed, price retraced to close up over here, right? This retrace up is this candle moving up. That's where it's retracing up to, right? So this is where it's closing. So now basically now you're looking to see that, okay, perfect. We are in a downtrend. Price made a low. Price is retracing. So all I got to do now is to wait for a resistance to be formed. Something like, let's just draw a resistance here. Resistance to be formed, something like this. And then I'm going to start to take a sell. I'm going to start to take a sell after this candle forms like this. And this will be my selling opportunity, right? So now when this candle has formed, this is the start of the new daily candle. Make sense? This is the start of the new daily candle. So now you're anticipating this next candle. Now, this is your confirmation candle after this mini resistance. And now you're anticipating the next candle to continue down, right? So what happens? The next candle forms. It forms something like this. Where's my rectangle? It forms something like this, but it wicks all the way up. It wicks all the way up to stop you out, and then it starts to go bearish. Let me just bring my arrow. So then it starts to go bearish. Now when it's starting to go bearish, right, this is where you start anticipating a move. Right now when you're looking at the overall daily candle, you're like, okay, you know what, the daily candle is maybe filled up till here. So I'm still anticipating price to continue down, because maybe this move up was a liquidity grab because it stopped me out. So maybe this was just a daily wicking form. Someone in the chat here saying the colors of the candles are confusing. Well, you can just leave the stream then. Okay, perfect. So now if you're still anticipating price to continue down, now you're saying that, okay, I'm going to maybe enter a second position once price breaks the previous candle's low, because I'm still anticipating price to continue bearish. I'm still anticipating on the higher time frame for price to continue down to fill this wick right over here. Right, so now what about the stop loss? When this low is broken, what I've been doing, I've been placing stops above the previous candle high. Because, if this wick is too big, it's going to be way too big. So above the previous candle high, so far it's been working. So that's where I'm taking a second entry. That's where I'm saying, okay, now I'm going to give my trade a second chance. But at the same time, you're keeping your risk intact as well too. Right? Let's say the first entry you took, your risk was 1%, you got stopped out. Now you have to identify that, okay, if you're going to give this trade a second chance, are you really going to go in with the same amount of risk you had in the start, or are you going to cut down your risk? Now, risk is something very personal. You have to really, come up with your own risk scenario. So that's how I'm going to be taking second entries when price breaks the low of the previous candle. I think to really understand this, if someone doesn't still understand this, you'll have to rewatch this maybe like 3 or 4 times. All right. You have to understand the visual formation of candles. Yeah, so this is what I was talking about. I really didn't make these charts. Rakil made these charts, and I'm just going off these. Right? So you really have to understand the visual formation of candles. That's what we did right over here. When you have 2 high time frame candles, they're filling the wicks. You have to break down 2 candles into simple market structure to see what's going on. Let's continue on to the next one here. Okay, now when to take second entries, right? This is going to be really, really important. When would you want to take second entries? And the best place, so the best time to take second entries is going to be when you have the same bias. You know, when you're in a sell and you see that there's room to fall and you see that there's enough range, there's clean traffic to the left and you get stopped out, you have to keep the same bias. A second entry doesn't mean that if you get stopped out, now you're going to take the opposite trade. No, that's a new trade idea. You're following on the same trade idea. You're following on when you're keeping the bias the same. When you have a buying bias, you take a buy after a support is formed. Let's say price goes up, makes a high, comes back down, creates a support, right? You take a buy, price stops you out. And then price starts to go back up again, then you're taking the second entry. A second entry is an impulse entry when the price is breaking the high of the previous candle. You know, so now your bias is the same. You can't change the bias. If you change a bias, now you're going into over trading, right? Now you're saying that, okay, you know what? I took a buy, got stopped out, so it's probably a sell. I'm going to take a sell. That's not going to work. It's going to be very, very hard. Let's go to the next one here. Keeping risk in check. Very important. Extremely important. You know, sometimes what happens is the guys take a trade, they get stopped out. And when they get stopped out, what they want to do is they want to up their risk. They want to say, okay, you know what? Now I'm going to make this loss back. I took this loss, I took this L, but I'm going to make it back. Because, like, you know, this loss, it should not have happened. So keeping risk in check is really important. And being very logical about the trade, right? Being logical about the trade is that, so let's say that you have 2 candles, right, going up. You have to be logical about the trades. And being logical about the trades means that, let's say this candle wasn't formed. You know, so when this candle created a low, now you're expecting it to break the high of the next candle. That's when you start being logical, because if a candle creates a low and it hasn't broken the low of the previous candle, and if it's about to break the high of the previous candle, then there's a higher chance price will continue in that direction. If you're looking at the higher time frame, let's say the 4-hour or the daily, it's going to happen most probably. That's where, like, you know, guys put their pending orders, they put their buy stops or sell stops, because if they know that the 1-hour candle is going to break a high of the previous 1-hour candle, this means there's a very high chance price will continue in that direction. Because price, if it's moving up, it's going to make a high, it's going to make a low, it's going to make a higher high, higher low, and a higher high, and a higher low, and a higher high, and so on. You know, candles, they move the same way. If they break a high, and if they haven't broken a low, there's a very high chance it will continue in that direction. In the opposite side of the spectrum, if you have a price creating a low, and you have a candle that's forming, and it's created a high, and it's about to break the low, right? And if it breaks the low, then there's a very high chance price will continue moving down after it breaks the low. Makes sense? And that's your trade. So this is supposed to be happening on a higher time frame, like a daily and a 4-hour, and then executing on the smaller time frame. So this is what they mean when they say that you need to look for trades on the high time frame, and then you have to go to the smaller time frames to execute. Because on the smaller time frames, you're looking at more information, like, you know, support form or resistance form. So then you're taking the trade based off of that. Let's go to the next point here. Let's see what the next point says. Man, Rakil made these slides here. Taking a second entry is very aggressive and very risky. That's absolutely true. You know, whenever you take a second entry, you are adding risk to your already added risk. A second entry means now you lost the first trade. Now you're taking a second trade, and you're adding more risk now. And it's aggressive because you're anticipating price to break the low of the previous candle in a bearish trend, or you're anticipating price to break the high of the previous candle in an uptrend, right? So basically doubling down, but you're managing risk. It's very important. Don't attempt it if you cannot differentiate between a bullish and a bearish candle. This is a complicated, advanced concept. It requires a lot of discipline, and don't do this if you don't know how to even enter a trade. If you don't know how to even operate a MetaTrader, don't even attempt this. So you need some prerequisite knowledge to even attempt these second trade ideas. So we're going to go over to some of, we have some examples here, and I'm going to need some participation here from the Zoom chat. I know we have like 52 people here. So even if, 2 people participate, it's going to be pretty awesome. Perfect. So right over here, we have price that is bullish, and now it's printed a bearish candle. Price has printed a bearish candle, and what we see from here is that maybe, there's clean traffic here that went up, and there's a high chance price can go down, right? Perfect. So we have a resistance right over here. If someone is drawing resistance, thank you so much. You have a resistance here. So when you're looking to take this trade, you're basically saying that, okay, you know what? We had a bullish candle. We had another bullish candle, which closed with a small body. A small body means there's less volume. So if a bullish candle closed with a small volume, what we're going to do is we're going to put a stop above this candle and execute a sell to maybe first fill this wick and continue down to fill this range, right? This is going to be the perfect trade. So let's see what happens in the next candle, because now we're anticipating price to continue down. And next candle stops you out, right? The next candle, it stops you out. So now this doesn't mean it's a buy, because it's still closed below resistance. You have one candle closing below resistance. You have another candle closing below resistance. You have this candle closing below resistance. You have this candle that stopped you out right over here. Now you could have had a stop up over here, but this is going to be a very, very big stop loss. So another candle stopped you out. So now this candle closed below resistance, which means it's not a buy. A buy is going to be when this candle closes above resistance, right? So you got stopped out. Now you're thinking, oh man, now what do I do? So now when you have gone through this webinar, when you truly understand what breaking the lows of the high means, then you can possibly enter a trade. So now basically what happens is that, let's say the next candle, right? The next candle, when it breaks the low of this candle, then there's a very high chance price will continue moving bearish. That's what's going to happen. But at the same time, you have to be mindful of the fact that now your stop is not going to be up over here. Your stop is going to be up over here, above this candle. So you're waiting for price to break this low and then continue moving down. Because here's what's going to happen. If you don't wait for price to break the low, what can eventually happen is that maybe the next candle, it can kind of form something like this, right? Because we have a bullish candle on the 30-minute time frame. So you have to wait. If the next candle creates an upper wick, I would enter when it breaks the low of the candle that stopped me out with stop loss. That makes sense. Yeah, it makes sense. But we're trying to explain here something very, 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 very simple and ground to earth. So let's see what the next candle does. So the next candle, it basically breaks the low and continues moving down, right? So this is why you're waiting for price to break the low of the previous candle. Of course, you can enter when price is retracing, but you need confirmations. You need to be very, very safe when you're trying to take a trade. Because again, when you have a bullish candle forming, there's a very high chance that the next candle can create a wick down, respect the low right over here. It can respect the low and then continue going bullish. So that's why it's really important for you to wait for price to break the low once you get stopped out the first time. Because now you're giving your trade a second chance, So this move down, once it starts to break the low, right over here, This is you're giving your trade a second chance. That, okay, I got stopped out. Now I'm going to give you a second chance. And another very important thing to notice. Now, when we were talking about stop losses, this was a conservative stop loss, right? On your second entry. A more aggressive stop loss would be up over here. Make sense? I'll tell you how this would make sense as a more aggressive stop loss. The way it's going to make sense is now, if this candle is breaking the low of the previous candle, then there's a higher chance it will continue down to make a new low, right? And once it's breaking the low, then there's a very high probability that the price will not come back up to break the low it created itself. Let's just let that sink in for a sec, right? Let's just sink in, because when price is breaking a low, let me just explain this again with another color. Statistically, if you use a blue color, people understand blue color more, because I think it's a more friendly color, or I don't know what the fuck that means. But if this candle stopped you out right up over here, right? You're like, okay, perfect. I got stopped out. Now I'm going to wait for a second entry, right? So when this candle forms, it creates a high right over here. It creates a high right over here, and then it starts to break the low of the previous candle. When it starts to break the low of the previous candle, now you're anticipating price to continue moving bearish without coming back up to retest the high it created. So that's where you're going to have a aggressive stop, right? This is going to be an impulsive entry where your stop is going to be above the current candle that is breaking the low of the previous candle. This is really, really, really important. So you can watch this over and over again and try to just see how it works. So we're going to go over to the next example here in the next slide. Let's see what happens here. Oh yeah, see, it then starts to come up because there was support over here, and then it does its dance. All right, this one right over here, right? We have bearish movement. We have a bearish candle closing with a smaller body, and we have all this clean traffic that came up, right? So it makes sense for price to continue on down. Let me just drink a... All right, let's just remove this. Okay, let's see what happens with the next candle, right? Let's hypothetically speaking, let's say you put a stop loss right over here, and you try to take a sell for price to continue down, and the next candle forms is like this. This is how the next candle forms, right? So now your bias is still bearish, okay? Your bias is still bearish, and let's say hypothetically speaking, you had a stop up over here, which got stopped out by this candle. So now you're like, oh man, now what? You know, we got stopped out. Price is probably creating a support. Now what I'm going to do is I'm not going to change my bias, right? This is really important. You're not going to change your bias. You're going to keep the same bias. The one problem people make is when they get stopped out in a sell, they just switch to buys, which makes no sense, man. It makes no sense. Why are you changing your bias? You can't change your bias. You have to stick to your idea for the day. If you think that you're only going to take sells, you have to stick to your sells. If you think you're only going to take buys, you're only going to stick to buys, right? So let's see what happens with the next candle here. We wait for the next candle. The next candle breaks the lows of the previous candles, right? When this low is broken, now you can turn around and say, okay, you know what? Now it makes sense for price to continue down, because I had the first opportunity right over here, which got stopped out with this big bullish candle that formed. And then the next candle, it broke the low of the previous candles. When these lows have been broken, now there's a higher chance for price to continue down. And I think this was a trade we called in JPY this past week. When price just fell, it just kept, because this move up was a move from interest rates overnight. They had a surprise cut. And then we had a move down in New York session. So you see, now price, it created a high and it created a low. and now price made a lower high and it made a lower low, and the next candles, they continued on to create lower highs and lower lows, lower highs and lower lows, right? So this is how a trend moves. A trend moves the same way. Trend moves down, goes up, down, goes up, down. So these movements, which are basically going up, these are retracements, right? So look at these wicks here. Retracement over here, retracement over here, retracement over here. So this is how price is moving. They're making lower highs and lower lows. And when price is making lower highs and lower lows, you're entering based on the fact that as long as price is moving down, it should not break the high of the previous candle. Some people are asking some dumbass questions here on YouTube, man. I don't even know how to answer these questions. So, I'm not going to answer those questions, right? So they're making just lower highs and lower lows. But right now, we're just focusing on when you have a bias and you take a sell right here, you have a stop loss, you get stopped out, then you're waiting for price to print a candle which would make sense for it to continue moving down. Let's go to the next chart. This is actually not a theory. This is just basic logic. I watched candles for a long time. This is just basic logic. So let's say we're over here, right? We're over here. So let's say price came down, started to consolidate here, right? Starting to consolidate. You're looking at the time here. See, it's 10:30 consolidation, 12 consolidation, 1:30 consolidation. So when you're looking at consolidation, right? When you're looking at consolidation, you're trying to understand why price is consolidating. Maybe there's no volume, right? Maybe there's no volume. So when we go back to our timing here, let's go back to our timing here for a sec, because people forget. So when we look at these timing here, what does this timing tell us? This timing says that, okay, there's going to be some sort of this is the time when there's volume. After this time, there's no volume. Then you have volume at this time. At this time, there's volume. If there's no volume at this time, then there's going to be volume at this time. If there's no volume at this time, then there's going to be volume at this time. So volume in the market comes from different time blocks. So these are time blocks, right? You have one time block right here, pre-London. You have another time block here at London, pre-New York, New York and London close. So these are time blocks you have. So when you're looking at the chart that we were just looking at, let's just go forward here really quick. And let's go to the chart we were looking at. Right. So now when you're looking at this chart, you're looking to see that, okay, we have this consolidation, and this consolidation is happening in this time block. You had 10:30 p.m. consolidation, 12 consolidation, pre-London 1:30 consolidation. So you're like, okay, if we're consolidating at this time, then when is the next time of volume? That's going to be at London Open. So you're like, okay, let's just wait. So you wait for the next candle, and the candle prints bullish, right? Candle prints bullish. Now, even though this price is ranging, right? Even though price is ranging right now, if we just look at this, what's the probability of the next candle going bullish? Right? We're moving into London Open. We're moving into time where there's a lot of volume. What's the probability of the next candle going bullish? Oh, looks like no one knows here. Oh, no answers. Are we hesitating? Come on, man. God damn. It's only what time? It's 9:30 a.m. and everyone's just quiet as if they're sleeping. Man, YouTube chat is much more active than you. Yeah, right? Like it's a higher probability that's going to go up. So let's say, hypothetically speaking, that you do take a trade. You take a trade, you take a buy, you put your stop loss down over here. You're like, okay, the next candle is going to continue up and we're going to have a good day, right? But when the next candle starts, it does something like this. It stops you out and like, oh man, okay, it stopped me out. It stopped me out. Now what I'm going to do? So now one thing to note is that this candle closed a doji candle. So when this new candle starts, now you're looking at the fact that, okay, now since this candle is starting and I got stopped out at this candle, right? Maybe I can enter once this new candle starts to break the high of this doji candle, right? And once it starts to break the high of this doji candle, I can probably take an aggressive impulse entry and have a stop loss below the current candle that is forming, right? This will be the second entry that you're going to take. So the first entry again is going to be on. Let me just remove this here. So first of all, you're going to start to enter. Maybe you're going to say, okay, you know what? This candle is forming bullish. We're coming down from a support, and if we want price to go up, we want price to make a high, make a higher low, make a higher high, higher low, and a higher high. You know, and you take an entry. Your stop is down over here. This candle forms. It stops you out. You're like, oh man, stop me out. Okay, if it stopped me out, it doesn't mean price is going to go down. I mean, price can go down, but now you're going to look for more confirmations for price to go up. You know, so now when this new candle starts and it starts to break the high of the previous candle, then you start taking this information that, okay, if my bias was still bullish, and if I'm anticipating the candle to continue going bullish, and it's breaking the high of the previous candle, what's the probability that it's going to continue going to create a new high or a high high? You know, if it's going to continue going to make a high high, then it should respect the low it created right over here. Then the candle should have no business coming back down to retest the low if it's breaking the high right over here. Make sense? This will require a lot of practice, you know, like if this makes sense to you guys right now, when this is in a live environment, this will require a lot of practice. So don't think it's easy. This is an advanced concept. If you're new to trading, this will be not easily digestible, you know, because this is an advanced concept. You need to understand how candles form and how candles, like, you know, how lower time frame candles, they form the overall higher time frame. What about a pending above the high of that range? Yes, that's a very good question. You can use a pending as well. Some guys are here talking about buy stops. You can use that as well, buy stops. That's the whole idea. That's where I use, like, you know, pending orders for my news trades. And the next candle just, you know, does go up and then does its dance and whatever it had to do. You know, so that's how you're taking your second entries. Let's go to the next one. Oh, perfect. So what do we see over here? What do we see over here? Price moving up, potentially price moving up to this area right over here, or even up to this area right over here, right? Now, if price is moving up, price making high, making a low, making a higher high, making a higher low, and making another higher high. You know, if price is making a higher high and a higher low, what this means is for this candle, the next candle should respect the low of this candle and continue moving up like this, right? Because if it's trending up, this is a 30-minute time frame, by the way, right? This is what it should do. So let's see what happens to the next candle. Oh, the next candle, it probably stops you out. Let me just get my eraser here. Right. So you take a buy when this candle starts, you put a stop loss below this candle, and this wick down stops you out. So now this candle has closed bearish, right? If this candle has closed bearish, this means now price should continue moving down. Makes sense? So if we draw a zone right over here, now this means price should continue moving down, because maybe price created a high right over here, candle has formed bearish. Now if you put a stop above this candle and take a sell, it should potentially work out. But no, because now you're changing your bias. You have to stick to the same bias. That's the key. That's the key here with taking second entries. When you're taking second entries, you have the same bias. You're not changing bias like a retard. You're being smart about it, and and you have the same bias. So let's say you have the same bias. You're like, okay, you know what? This stopped me out, whatever. I'm going to wait. I'm going to wait for the next candle. And if the next candle starts to break the high of this candle, then possibly I can take an impulse entry, having a stop over here or whatever the case is. And then you can eventually we can start to go up or whatever happens. You know, so you go to the next chart here and next candle starts to go up. Right? Now, on average, I used to miss these moves. On average, I used to miss this move up because I would say, okay, I'm going to wait for this candle to close. After this candle closes, I'm going to take a buy and we're going to have a good day. But the problem is now your stop is too big, man. You have a very big stop loss. So you have to really adapt to what's happening in the markets. Now, once this candle starts to break the high of the previous candle, then you start thinking. You start seeing, right? Now, this did not came to me all of a sudden. This came to me by watching it happen over and over again. So you start seeing, you start applying logic that, okay, man, if this candle is breaking the high of the previous candle, what are the chances it's going to continue moving up? If it's breaking the high, provided it has made the low right here, the chances are going to be pretty high, you know? And that's the trade you're taking now. That's the second entry you're taking on the trade logically, that now it's breaking the high, so it makes sense for price to continue moving up. Makes sense? So now you're identifying the stop loss to be maybe below the previous candle low, or you're identifying the stop loss to be below the current candle low right over here. And then price starts to move up and you have a good day. Let's see what happens with the next candle. Oh yeah, it'll start to go up. Perfect. Right? Awesome. So that was the webinar. We went over second entries. We also went over candle highs and candle lows. So what we're going to do now is we're going to take a 5-minute break, and then we're going to do a simulation for around 1 hour. So we're going to be right back.